Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jon Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live from New York City this afternoon. Good afternoon. Good afternoon. That Fed decision 27 minutes away. After that, 30 minutes later, a news conference with Chairman Powell. And one word on the minds of everyone on Wall Street: dissent. Dissent, dissent.
There is the expectation for two potentially Fed governors to dissent for the first time since 1993. Of course, we're talking about Michelle Bowman as well as Chris Waller, and that would really put potentially a real question of what this does to political interference as well as the path ahead for the Federal Reserve.
It started with a single voice of Greenspan, and Lawrence Meyer writing about it years ago. And John, I think it's refreshing. I wish it was more like the Bank of England. I mean, you've seen fist fights at the Bank of England.
I agree with you, TK. I think it's healthy. It's a good thing if there are credible arguments to make the call. However, if you're ambitious and you would like to become the next Fed chair, is now the right time to throw your name into the hat.
This is the reason why the messaging is going to be so important, especially as we get upside surprises from a lot of economic data earlier today, the GDP data. I understand that it's a little bit complicated, so I think that we will get into that, but it raises the question, what will be the justification that now is the moment to pull the trigger, and how many more rate cuts could there be going forward?
In the last 12 hours, John, it's less of a snooze fest. You've got dollar moving, you got weaker euro, and the GDP data, Jason Furman, we'll get to it, was brilliant on this weak economy.
And equities for much of the last 2 months, up and to the right. The rally continues. Equities positive by 0.2% on the S&P 500. Stocks higher by more than 6% since this Federal Reserve last met.
Yeah, and bonds not doing that much. Coming up shortly, we're going to be talking about all of this with JP Morgan's Bob Michael, who is around the table with us, Kathy Jones of Charles Schwab, and Subhadra Rajappa of Soc Gen. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Was there any dissent? We will discuss. Then we'll get immediate reaction from Jim Bianco of Bianco Research, Diane Swank of KPMG, and Bank of America's Aditya Bahav. And then, after we get Chair Powell's news conference, we'll be talking with former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg to understand the implication of this very important Fed meeting.
Lisa, thank you. Let's get it started. Bob Michael of JP Morgan Asset Management with us around the table. Bob, good afternoon.
Happy to be here.
It's good to see you, sir. Dissent. How much dissent are you expecting, and how instructive might it be?
We expect certainly one dissent and possibly two. If we see two, I think it indicates that Chair Powell has lost a little bit of control on the FOMC. I think it's seismic. The last time there were two dissents was 250 odd meetings ago. That's 0.4% of the time. If you're going to dissent, you better be really sure you're going to be right, that you have the data and the rest of the committee is wrong. How many of us have been in investment policy meetings or corporate strategy meetings where you hash it out? And if you disagree where the consensus is going, we always say, convince everyone else to change your mind. If you can't do that, maybe actually your argument isn't as well founded. Whatever happens, what we agree as a team, that's what we go out and say. We can always talk about this are the risks to our forecasts and expectations, but you don't go out with multiple forecasts. That's what I see with two dissents.
At the same point, they're not an investment committee, and they don't have to go out to pitch somebody an idea with the same kind of conviction that maybe a fund manager does. At a certain point, have you ever seen this wide of a spread of potential outcomes and a wide interpretation of economic data? Isn't there some sort of justification for a level of uncertainty and dissent, especially on the FOMC?
No, we've seen the great financial crisis, of course, was seismic in and of itself. We just went through COVID. We talk about the potential economic outlook is uncertain. That uncertainty has cleared up to some extent since the last meeting. We have the details of the One Big Beautiful Bill Act, and we have a lot of trade agreements in place, and we know where they're headed. So a lot of the uncertainty is past. Now, what are we going to do from a policy perspective? I think that's a different argument. And probably the best thing to do is nothing until you see the impact of either the One Big Beautiful Bill Act down the road or tariffs.
Bob, let me frame this for you. I'm sure you got a briefing from Michael Ferroli in the 10 o'clock hour. Jason Furman up at Harvard says annualize the first 2 quarters. And if you do so, he's got a run rate real GDP of 1.2%. That's a Donald Trump cut interest rates economy. Did the winds tilt this morning towards the governor and towards a rate cut now?
So you brought up Mike Ferroli. He's got on average 0.75% for the second half of the year. The problem is the details of the forecast. You've got core personal consumption expenditures steadily rising to an annualized rate of over 4%. And by the same token, you've got unemployment rates rising into the mid-4s.
Yeah.
That's a difficult equation for the
John,
Fed to
this
solve.
is the heart of the matter. I've never seen the equation this messy, ever.
They've got a lot of reasons to wait. 2 more payrolls reports, 2 more CPI reports. You get to September 17th. Is that enough information to make the call in a few months' time?
Absolutely not. All that's going to tell us is what we're seeing today. We haven't seen the full impact of the tariffs for a full quarter. We're talking about in a couple days, the tariffs will take hold. So you're going to see a month or 2 of the impact. We need to see what happens in the fourth quarter. We need more data. We think they're likely going to be on hold in September as well.
So if you have to wait until December, what is the risk out there that inflationary pressures are building? Because that would be the argument to remain on hold, that actually inflation is more of a threat than any kind of potential weakness to the labor market. So where is that coming from on a sustained level, given that a lot of consumers have really pushed back against higher prices?
Well, the June inflation data showed that we are starting to see some of the pass-through in goods inflation. We're going to see a heck of a lot more over the next couple of months. We also have an employment market where unemployment is in the low 4s. By a lot of definitions, that's full employment. That's the data today. That's not telling you that there's a lot of weakness. Yeah, we project that perhaps the labor market will continue to weaken from here because businesses are frozen until they see the full impact of tariffs on their business. But that's down the road. That's not now.
So if they were to cut or they were to have a dovish tilt, do you expect a material sell-off in the long end of the yield curve?
I think it depends in the press conference how dovish Powell is. Certainly, the last time we saw dots, we saw 2 cuts for this year. I think he'll still reiterate that they're biased to ease, but I don't think he's going to pin himself into a corner by 1 or 2 cuts. I think he's going to reiterate they're patient, they're data dependent.
10-year yield higher 3 basis points, 435 this afternoon. What's the most compelling reason to buy that right now?
The most compelling reason is at some point they're going to bring rates down. That this is still a Fed looking for an opportunity to bring rates down. Does it happen today? Probably not. Does it happen in September? Maybe. Will it happen in December? Probably by then they'll have enough data. What's been interesting to us is how resilient the 10-year has been. We're pretty much right on top of the Fed funds rate. Every time I'm on one of your shows, we seem to be right around 440 on the 10-year. We never really go anywhere. Yeah, we go a little bit higher, a little bit lower, but we seem to wind up in the vicinity of the Fed funds rate. There's an awful lot of money looking to come into this bond market.
Take equities, bonds, currencies, commodities at JP Morgan. DXY, printing a 99 today. It's gone from -2 standard deviations to +2. For showbiz, that's a 4 standard deviation move. Resilient dollar. Muni bonds pounding the table, price down, yield up, buy muni bonds right now. What's the mix of the market here, and what does it signal to the Fed?
I think what the Fed is seeing is that there's good demand for bonds on average. There are still flows coming from overseas into the U.S. Treasury market, coming into the U.S. bond market. Now, are those flows fully taking the dollar? They started to hedge some of that out. Maybe there was a little bit of a reversal in the last couple of weeks, but they're more balanced on the currency side. When we look at the municipal market, there's been a lot of issuance before pretty much the August break. But we see a lot of money on the sidelines looking to come into the municipal market and buy it up. still every meeting I have with our client base is about where do we get into the bond market, how do we get in, when do we get in.
Have you got a favourite show? I'm insecure. We just want some love.
I love this show.
Thank you, Bob. Appreciate that. The president might be watching. This is what he's got to say this afternoon.
I'm going to tear up.
The chairman of the Federal Reserve probably won't lower interest rates today. I don't think many of you were expecting that to happen. That decision is about 20 minutes away.
I call him Too Late Powell because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He keeps the rate way up. I think it's Trump derangement syndrome. I think if Jerome Powell stepped down, it would be a great thing. He's spending $2.5 billion rebuilding the Fed. I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. He's a knucklehead. It's a tough construction job. It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
The President of the United States taking on the Chairman of the Federal Reserve, Chair Powell. The President speaking just moments ago saying that the Chairman probably won't lower interest rates today. Welcome to the countdown to the Fed decision on Bloomberg TV and on Bloomberg Radio. Your price action this afternoon is shaping up as follows. Equities look like this, up by 0.3% on the S&P, looking for another all-time high on the Nasdaq, up by 0.4%. Outperformance on small caps. In the bond market, 2-year, 10-year, 30-year bond yield to look like this, higher this afternoon by 3 basis points. Bramo, the 10-year, 435.41.
Yeah, but it's notable to say that July 18th, the last time the Fed met, rates were 4.42% on the 10-year. So they've actually come in since the last Fed meeting on the 30-year yield, also coming into 4.9%. So not exactly this freak out the way that there was about duration, about the deficit, and about some of the other.
And the 10-year real yield is range bound still. We haven't broken out either way. To me, that's a big deal.
The decision at 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Powell. Joining us now to discuss, Kathy Jones of Charles Schwab, alongside Bob Michael of JP Morgan Asset Management. Kathy, welcome to the program. Let's talk about the setup. In the statement last time around, the Federal Reserve said the labour market was solid. Governor Waller comes into this meeting and he's making the case this labour market is on the edge. Who wins?
Well, I think in terms of the decision, the committee wins in terms of not changing policy based on the labor market yet. But I do think that when we look at the data, we're seeing evidence of a languishing labor market. I guess that might be the word to use, where there's no hiring, there's no firing. We're just kind of hanging in there. It's not a bad labor market because the overall unemployment rate is low. But it's also not showing any sort of dynamic activity, which it should show if we're in a growing economy. You combine that with the slowdown in consumer spending that we've seen in the last GDP report, and there are signs of softening. But I think the committee will look at the overall picture and just say, not yet. You know, we're not there yet because inflation is still elevated, it's still closer to 3% than 2%. And we haven't fully felt the impact of the tariffs, and there's just not yet enough evidence for the Fed to cut.
Pretty much every morning of Fed Week, I whip out my previous copy of the statement and I look at the language and I say, what's going to change? And I was struck by the fact that last time around they said uncertainty about the economic outlook has diminished but remains elevated. Couldn't they say the same thing now? Is there anything that gives you the sense that it's less elevated now and that actually they have some economic certainty?
I wouldn't say so. This has felt like the calm between the storms. You know, we had all the volatility earlier in the year on the tariff proposals, and things have sort of settled down. But we still have the IEEPA ruling coming up, which people don't seem to be talking about. But we have all these sort of frameworks for tariffs. But what if the ruling goes against them? What will happen to all these deals that have been set and the way the market has adjusted to the prospects of them? And then, you have the slowdown in global growth. So tariffs not only affect the U.S., but they affect the growth abroad. And I think we're seeing that with the dollar up and the euro down. Prospects for growth in Europe are hit on the tariff. So there's a lot of stuff coming that could indeed slow the economy and cause the Fed to move to cut rates in September. It's still our call, a September rate cut. I wouldn't say my confidence is sky high, but it's still our call that we get a cut in September.
Bob, this Fed day is into tech earnings, Microsoft and Facebook. I'm not going to call it Meta, Lisa. I'm sorry. It's just
Carry
Facebook.
on this good fight.
We had wonderful earnings from Google. Is the Fed different than every other central bank because they got a bolt-on of American technology excellence? Is it just simply we've got this odd, what, John, AI is it called?
Is that what you're doing on
That's
Bloomberg
called-
Radio? Is that how advanced things are over
Yeah,
there?
I mean, it is.
What's going on?
I'm looking at technology, and is that the
Facebook?
Powell difference?
Figuring out AI?
So Tom, I think you're right. I think we forget we've been living with 10% baseline tariffs for close to 4 months now.
Yeah.
There are tariffs in place. The ability of corporate America to adapt to what's going on and continue to operate. We just heard Kathy talk about there's no hiring or firing. Corporate America just hit the pause button and continues to do the things that they do well and figure out where they're going to do the sourcing from and where they're going and how they're going to pass through pricing.
John, question to you. I mean, the Bank of England does not have this problem. They don't have a tech juggernaut to deal with.
Well, Europe doesn't have that problem either, or rather, Europe would like to have that problem because Europe doesn't have those big names.
Yeah.
And Europe would love to have those big names. I think that's what we're talking about here.
Yeah.
I think, and that's been an issue for a while.
Which is the reason why the resilience in the U.S. economic data raises a question: when will they know enough that inflationary pressures aren't significant enough for them to start easing more materially?
Let's bring in Subhadra Japa of SocGen to try and make sense of all of this. Subhadra, welcome to the programme. Let's talk about this Federal Reserve decision about 10 minutes away. The chairman of the Federal Reserve under a ton of pressure to reduce interest rates, the pressure coming from the President of the United States. Does this chairman have the luxury of waiting?
Actually, I think he does, especially given the fact that we did get a very strong GDP print for the second quarter. Today's ADP print also shows that private sector job creation is not probably as bad as it seemed in the last ADP print. So I think that they do have the luxury to wait. The question is for how long? I mean, the market's pricing in still 2 cuts for this year. I think September is still very much in play because we have 2 more jobs reports as well as 2 more inflation prints to digest before the September meeting. And if you start seeing cracks in the job market, I mean, as Kathy pointed out, I mean, the job market is basically in stasis. And the only way I think it's potentially likely to go is deteriorate. Under those circumstances, I think the Fed is going to be in a position where they're going to need to act quickly. And the question really is that, are they going to act preemptively or are they going to wait to get more data before they act?
When will they know that they actually have enough data to act, Subhadra? And this is something that John's been saying for quite a while. What I find compelling is this is coming at a time where there is increasing market expectation that the Fed is going to cut in September. And now we've got President Trump speaking at an event saying, I hear that the Fed will cut in September.
Actually, that would be my question to Jerome Powell if I had to ask him a question, because, to me, it feels like, they're waiting for a feed through from tariffs into inflation. It's not clear how long that's going to take. They're waiting potentially for a further deterioration in the job market. Again, it's not clear to me that that's imminent. So the question is, what sort of data points need to line up for them to be comfortable cutting rates? My personal take is that I think if inflation stays, say, between 2.5% to 3%, and the job market starts to deteriorate, I think then they're going to act, quite quickly to ease policy.
Kathy Jones, will we see that on Friday? I mean, carry it right forward to the jobs day on Friday. I don't see the unemployment rate cracking yet, although a lot of people are modeling out 6 months, 12 months out, you'll finally see that.
Yeah, I don't think this Friday's number will probably be that weak. Although predicting the non-farm payroll number is, a fool's errand these days. But nonetheless, and there are no signs that it's ready to fall off a cliff. But if the trend is towards deterioration and weakness under the surface, which is what we are seeing in some of the data, then I think the that the Fed, I think Subadra's right, that as we get closer to the September meeting, if we have a couple of months deterioration in the pace of growth in jobs and no big move up in wages, then I think that sets the stage for the Fed to say, okay, we don't need this so-called restrictive policy anymore. We can move somewhere closer to neutral. I don't know where neutral is or what they consider neutral, but they have described current policy as restrictive.
The guesses for Friday are amazing. If you haven't seen the guesses for Friday, here's a sneak peek. The high is 170, the low 0. 0. Stephen Stanley, Santander. That's how wide the range of estimates is going into the payrolls report.
Even wider is how to interpret those estimates, because on one hand, Stephen Stanley was here and still saying that he doesn't think they're going to cut this today, and he thinks there's a possibility they don't cut in September because of all of the distortive effects. How do you get conviction around policy when you have ramifications from bringing trade forward and then pushing it out that completely distorts data that a lot of people rely on? So
this is the issue, Subhadra. Bob was talking about this earlier. Is 2 CPI reports between now and the September meeting enough? Is 2 payrolls report between now and the September meeting enough to draw any conclusions whatsoever?
I think it is because of the fact that you have an aggregation of data for the year, which has been suggesting that there's a steady economy, resilient economy, but a gradual deterioration. You also have a haves and have-nots economy where the top half is doing better and the bottom half is not. The question really becomes, when do they start paying attention to the signals that they're getting on that's going to stimulate the bottom half of the economy, cut interest rates, perhaps try to stimulate the mortgage market a little bit, alleviate some of the stresses on credit card as well as student loan delinquencies. So I think lower interest rates will help all of the interest rate sensitive sectors of the economy. The question is, when do they actually act and how quickly do they need to react to a slowdown in that sector of the economy?
Well, Bob, to that point, there's this argument that a lot of people in the lower income sphere tend to borrow short. It's not necessarily the mortgage market that's borrowing long, but they borrow credit card loans, they borrow auto loans, they borrow other types of short-term instruments. Wouldn't there be a pretty big boost for these individuals if you did cut rates by 25 or 50 basis points that wouldn't necessarily be that inflationary, but that could really equalize some of what we're seeing in the income sphere?
Absolutely. We spend a lot of time looking at the securitizations of short borrowings, and what surprised us this week is how well they're performing. And when we talk to the originators of those loans, they're telling us that the borrowers are confident, that they are already starting to price in the benefits of the One Big Beautiful Bill Act. We looked everywhere to find stress in the consumer, and it's not there. Right. I'm also going to give you another very good reason why there don't need to be 2 dissents today, and the Fed doesn't need to do anything. They get a do-over. They get Jackson Hole a month from now. So they'll have another month of data. They can look at things, and if they want to reposition themselves, they can go back to Waller and Bowman and say, wait until then. I promise I'll go on stage and say we're biased to cutting rates.
Subhadra, the most important single line I saw today was from the Mag 7 company, Hershey's Chocolate, at the Abramowicz house. Trust me, it's a Mag 7 company. Their tariff estimate was shocking. Is the thing that we're going to see for the Fed coming up is company after company after company beginning to account for tariffs?
That is a big concern. You're starting to see a creep up, especially in inflation expectations. You look at, 10-year break-evens are starting to climb. 5-year forward, 5-year inflation break-evens are starting to climb. So you are seeing the feed-through from tariffs into the economy ever so slowly, even though tariff rates have been a little bit volatile. The concern for me is that if we start heading towards, say, 15% or 20% universal tariff rate, that might actually start becoming quite impactful. And especially if inflation expectations get a bit unhinged, then I think that's something that is going to also be difficult in an environment like that for the Fed to cut rates.
Subhadra, we've got to let you go. I know that. Appreciate your time. Subhadra Rajappa there of SocGen, Kathy Jones of Charles Schwab, with the decision only 2 minutes away. And just for the record, chocolate snobs around this table, right? Yes.
Are you looking at me?
Yes, absolutely.
Okay, fine. Tom said that my household is the single, behemoth holding up Hershey's. And I will just point out Hershey's milk chocolate typically contains about 11% cocoa. And typically I like a little bit higher.
You're more of a 60% kind of person, 70?
65, 70.
Yeah.
I enjoy that. I enjoy the actual taste of chocolate.
TK was projecting, I think.
What do you think so?
Much more of a Hershey's kind of guy.
You like 11%?
I'm a Hershey's kind of guy.
Hershey's
I
kiss?
learned that from Mike Nicklock a few years ago.
Hershey hugs?
He was a hockey player for the Hershey Bears.
Got any more brands out there? You got the list of them?
John,
Ready to go?
We're really close to the Fed decision. 1 minute away.
The tariffs
Let's go.
from Hershey's were jaw
You're trying to keep us in line.
No, the tariffs. Bob, help me here. This is a real deal. These tariffs coming in here is a revenue gain for the country. They're beginning to add up.
They are. They're going to be trillions of dollars. All you have to do is look at the CBO scoring methodology, and it almost perfectly offsets the incremental spend of the One Big Beautiful Bill Act.
Bob Michael is going to be sticking with us. The decision is about 30 seconds away. So here's the setup. Most people, no, almost everyone, expects no change in monetary policy in about 30 seconds' time. However, there are some people who are expecting some dissent. One governor maybe. If you get two governors, it will be the first dissent against the chairman, going all the way back to 1993. The decision, moments away. Equities are positive by 0.25% on the S&P 500. On the Nasdaq 100, up by 0.4. On the Russell, up by 0.9. That decision seconds away. 30 minutes later, Chairman Powell. For now, let's cross over to Mike McKee.
No rate moves, two dissents as anticipated, and no future guidance. The benchmark rate remains in a range of 4.25% to 4.5%, even though policymakers say that economic growth moderated in the first half of the year as, quote, swings in net exports continue to affect the data. Uncertainty about the economic outlook remains elevated, their statement says. They dropped the suggestion in the last statement that it had diminished. But there are no hints about future moves. September is not mentioned in the statement. There's no change in their line about carefully assessing data, the outlook, and the balance of risks in considering the extent and timing of additional adjustments to the target range. At the moment, labor market conditions remain solid and inflation remains somewhat elevated. Those were the characterizations used in the last statement. As anticipated, Governors Chris Waller and Mickey Bowman dissented the first time, as John mentioned, that two governors voted against a committee decision since 1993. They preferred a 0.25 percentage point cut. Governor Adriana Kugler did not attend the meetings or vote on policy. The Fed says she is attending to a personal matter. Guys?
Mike McKee, appreciate it. Fantastic breakdown, as always. As expected by many of you, policy unchanged. Two dissents, two governors, as Mike repeated, the first time since 1993. In the first paragraph of the statement, the committee says the labour market remains solid. This is the issue that Governor Waller has with the labour market and that kind of communication and language. When he made the case to cut interest rates in the last few weeks, he thinks this is a labour market on the edge. Ultimately, at this meeting, he failed to convince the rest of the committee to go with him.
Although he did get another Fed governor, and I am curious to see what their justification is, especially after the ADP report, the better than expected GDP print, a whole host of other economic data points that have come out, as well as earnings that have continued to surprise to the upside more frequently than not. This is going to be very much an emphasis on why from their perspective.
I don't agree with the 3% statistic today. I think we're at 1.2% domestic final sales. I love what Jason Furman did with a 6-month moving average. And you mentioned Bob Michael. Ferroli's at a 0.75 forward. I think the numbers are soggy. They were Trump-affilic numbers.
Let's look at the market. Equity is still positive, but fading, up by 0.2% on the S&P 500. In the bond market, yields just a little bit higher. Look across the curve on a 10-year up by 2, on a 30-year up by 3. The price action could get mixed up in about 28 minutes' time when we get this news conference with Chairman Powell. With us around the table, Bob Michael of JP Morgan Asset Management. And Bob, I want to come to you first, because ahead of this decision, you weren't just banning away those two dissents that could come on this committee. You said they were important. Why are these two dissents important this afternoon?
It's got my attention for sure. If I go back to December 1993, you had Wayne Angell and Larry Lindsay dissented. They thought policy was too accommodative. You know what? They were right. In January, the Fed came in and started a year-long doubling of the Fed funds rate. When I look at Waller and Bowman dissenting, they're seeing something that's meaningful enough for them to be the first Fed with 2 dissenters in over 30 years. You have to pay attention to that.
It's going to be really compelling to see how Fed Chair Jay Powell messages this afternoon in about 30 minutes' time when he gets to that podium.
Yeah.
What are you expecting him to say to explain why they were unable to convince the rest of the committee and whether he has lost control over the majority of the thought?
Well, I think he likes to be a consensus builder, so I expect at the press conference he'll try to close the gap and say there wasn't much disagreement in actuality, that if you look at the last summary of economic projections, we had 2 rate cuts in there going into year end. The timing of that was always uncertain. We had a couple governors who felt maybe we should be pulling it a little bit forward. The rest of the committee thought we needed to see a little bit more data, but we're all on board with a rate cut or 2 before year end.
This just in from Neil Datta of Renmac. Waller and Berman dissenting tells you the FOMC will eventually move in the direction of the dissenters. Let's extend the conversation. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme. Just first of all, your reaction to the statement and the dissent of the FOMC.
The statement and the dissents, I think, were as expected. There's really not a whole lot to be surprised about it. Maybe that Mickey Bowman did it, but I'm not shocked that she did at this point. Waller, I think, is going to have an interesting case to be made when the blackout is lifted on Friday as to why this is not an audition to succeed Jay Powell and as opposed to being an economic case to really cut rates.
You said that you're less surprised about Mickey Bowman and that actually that's less of a preeminent concern for you. And yet she was the dissenter last September when the FOMC did cut rates, and she said she didn't think that they should. Does this seem a bit like an about face when it comes to her approach to monetary policy?
It might be. It might be in terms of the way that she's been looking at the economy lately. And, it's been a bit, in at least my read, somewhat inconsistent, but not a whole lot. And so, yeah, it does kind of have that feel that it's an about face.
Jim, you're a trophy taken. You were one of the first ones there saying inflation, sustained inflation, we're not getting a disinflationary vector. I want you to revisit that right now, given 2 dissents, given the understanding of a slowing economy. Are we still going to see persistent inflation?
I think we are. I've been using the case that whenever you have a recession or a financial crisis, and we had both in 2020, that the economy fundamentally changes. And if you want examples of that, deglobalization and remote work are probably top of the list. This is not the 2019 economy. I know Chairman Powell likes to say that we see broad signs that the economy is normalizing or returning to pre-pandemic levels. That's another cycle. We're in a different cycle right now. And this is a cycle of elevated inflation. I think that the inflation rate is going to run around 3%, maybe as high as 4%. But I like to caution that I did not say 8-10 or Zimbabwe inflation. And with that type of level of inflation, and that's largely what we've seen, we've averaged over 4% in the last 5 years on the inflation rate, that the appropriate level for the funds rate is about where it is now. And the Fed should not be talking about cutting rates when you've got all-time highs in the stock market, in housing, in crypto, all the way down the line. I don't know what problem they're trying to solve that they think that they need to give us easier money.
Add on to that, Bob Michael, as you can. Synthesize all of J.P. Morgan about the nation's productivity, our technology overlay, and the persistency of inflation Mr. Bianco talks about.
Yeah, I think Jim's on to something. And if I were on the Fed, I'd be worried that corporate America is bottoming in here. They're learning how to absorb tariff policy, so they're pausing on a lot of things. But once we get through this year and head into next year, they'll start spending again, and we'll be left with a labor market that has unemployment, call it in the mid-4s, but we don't have the immigration coming in. So now you've got a labor market with unemployment in the mid-4s, corporate America starting to pick up a little steam again and starting to hire, and you're back to tightness in the labor market. So I understand where Jim is coming from. It's something that I worry a lot about. We'll see what happens over the next couple quarters.
Based on the conversation you guys are having, though, the Federal Reserve's got a problem. Because the way the Fed has communicated under Chairman Powell over the past few months is that the only reason they're not reducing interest rates is because of the tariffs. He's not talking about any of the things that you're talking about.
Yeah, and it's good cover for now to say tariff policy is one of these transitory inflation impulses. That's probably true unless it becomes embedded in wages. Unless we get into the first half of next year and we find out the labor pool is actually tighter than we thought, and without the immigration inflow, suddenly existing workers demand higher wages. That's a wage price spiral I would worry about. That's putting a lot of horses and carts in front of each other right now. I get it. But it's also a good reason for the Fed not to rush to cut rates right now.
Jim, you were taking us there. I just want to squeeze in a final question with you, sir. Just how messy this September meeting might be. It might be easy to get through this one. But when you get to September, how much of a mess will it be in a few months' time?
I think it could be a big mess. I think that the data is not going to be consistent for the Fed, what they're going to be looking at. There's an argument to be made that there's a residual seasonality in CPI data that's going to show up in the second half of the year and push it higher. That will give them pause to want to cut rates. I think that the president, again, within the last hour, has pretty much laid on the law that he expects them to cut rates in September, or he might wind up having to take action himself, whether or not that's appointing another chairman to replace Powell or to actually consider firing him. So this is going to be like the last, quiet meeting. I think when we get to September, it's going to be a much different ballgame.
Hey, Jim, thank you, sir. Jim Bianco there of Bianco Research. Thank you very much. Reacting to the Fed decision just moments ago. Policy unchanged as widely expected. 2 dissents from 2 Fed governors for the first time since 1993. As Jim just said, this meeting could be the easy one. The next one gets a whole lot harder.
All of a sudden, you're expecting to see that inflationary impact from the tariffs that will trickle through in a more meaningful way. A lot of analysts saying you just have to wait until the third quarter and fourth quarter to start seeing that, because Hershey's is getting more expensive as they expect tariffs to roll through. This really is the question. If you're not seeing significant weakness in the labor market, how do they justify it?
The news conference, 20 minutes away. Diane Swanker, KPMG, joins us now for more. Diane, welcome to the program. How is Chairman Powell going to navigate this one?
Well, I think one of the key issues that we haven't talked about yet is the implied PCE index, which the Fed targets, which was in this data today. And that suggests what was in the data today suggests before revisions, we could see an 0.5% core and overall PCE index, the highest core PCE index at 2.9% since March of 2024. That is not a number the Federal Reserve wants to see, and that's ahead of the full effects of tariffs kicking in, which takes 6 to 18 months. And so we're going to start to see more of that tariff-related inflation. The inflation, by the way, today, the acceleration was in both goods and services. That is also worrisome for the Federal Reserve because it suggests that perhaps there may be some contagion from tariff inflation from goods tariff inflation into service sector inflation. And that is exactly what those who are most hawkish on the Fed are worried about. And that's the data we're going to get tomorrow morning. But it's in this data release that we got today.
Diane, I'm watching the long end of the yield curve, and I'm wondering how much the bond market's going to start to worry about a pickup in inflation on the back end of some sort of rate cutting cycle. You're not really seeing it in any kind of massive way. It is early days. We haven't gotten the press conference. How closely are you watching that indicator for a repeat of what we saw last year, if there is this dovish tilt in the expectation of several rate cuts for the remainder of 2025?
Well, first of all, I think Chairman Powell is going to be very cautious on all meetings are live. We'll take the data as it comes in. We're wait and seeing, but he's not trying to do forward guidance here. That doesn't mean he won't say the meeting still could be live in September, because it could be live in September. He may not have enough information to telegraph that at the Jackson Hole Symposium, but the bottom line is he will be saying that all meetings are live. That doesn't mean the Fed will be cutting in September, and we actually don't think they'll be able to cut in September unless you see a very much larger deterioration in overall labor market conditions. We agree with the economy has slowed. Domestic demand has slowed. The economy is slowing as inflation's picking up. That is that stagflationary kind of environment that the overwhelming majority of the Fed has been expecting, and what they're waiting to see is which effects are larger ultimately. Waller still feels the margin of error is very narrow for the labor market. I can have sympathy and empathy for that point because, listen, hiring and the pace of hiring, the pace of quits, they're below 2019 levels. They're consistent with much higher unemployment rates. But as Bob mentioned, we have curbs on immigration that are going to kick in and create pockets of labor market shortages at the same time as we get into 2026. That's a very hard situation for the Federal Reserve and the threat of a more persistent and pernicious bout of inflation and why we don't have the Fed cutting until the end of the year.
Diane, just on these dissents, how convinced are you that these are credible economic arguments and not just auditions for the chairman's job?
I actually think Waller is a very credible economist. And certainly there's a lot of politics at play here, but I think he's really sincerely worried about the strength of the economy. You can hear it in the cadence of his voice. I've spoken with governors of the Federal Reserve. I think he's very, very concerned about where the labor market is. And he has some credibility within the Federal Reserve Board of Governors because he looked at the overshoot on job openings and said we can get a soft landing out of this. And now we're on the flip side of that where he's saying, listen, the labor market stuff is saying that it could be much weaker and demand has weakened. The question is whether or not, I don't think it's a one-time bump, and I don't agree with him on that, but we won't know until we get there. And that's where the uncertainty within the Fed is. And I think it's interesting that uncertainty came back into the statement as well.
You'll have to forgive me for following up, but the obvious response to what you just said, Diane, all of those nice things about Waller, nothing about Governor Bowman. Why not?
Governor Bowman is more on the vice chair of supervision. She's not as much an economist. She doesn't carry the same weight on her economic analysis as Chris Waller does. It's just plain and simple. Not going to get into the game of politics on this one because I think, frankly, that's not a useful place for the Fed to be, nor anyone commenting on the Fed at this point in time.
I had to ask. A diplomatic response, no doubt. Diane, stay close. I want to bring Mike McKee back into the conversation. Mike, you've had a second look at the statement as you go into this news conference in 15 minutes' time. Mike, I imagine you're starting to think about questions to ask the chairman. What kind of questions do you want answered this afternoon?
Well, I think one of the most important questions, John, is going to be whether anybody else on the committee, even if they did not vote or did not vote to dissent, agreed with the Waller and Bowman position. Is there more of a move in the Fed towards a cut than we had seen? We also want to know more about what they're thinking in terms of the bigger danger. Is it unemployment at this point? Is it the labor market? Or is it inflation? They were very sort of anodyne, not changing much their analysis of either one this time. The big picture that we're missing right now is the labor market because it's still, as they say, solid, but that's backward-looking data. We don't get the latest until Friday. The inflation numbers, as Diane mentioned, we can also already pretty much calculate, and we know it's going up. The GDP numbers today, one question is the business spending numbers were dismal, but was that because companies are sitting on their hands waiting for tariff decisions? Or is that because they've decided now that they're going to pull back because the economy is slowing down? A lot of unanswered questions. I'm not sure how many Jay Powell can give us answers to, but those are the kind of things we might see in the press conference.
Mike McKee, thank you, sir. We'll let you run. Mike McKee there with the breakdown of the Fed decision. The objective of Chairman Powell has to be to make this boring. This should be boring. And as someone said to us earlier on this morning, if the most entertaining thing about this is two dissents, then this is a boring meeting at the Federal Reserve.
There is not going to be anything boring about this press conference because Fed Chair Jay Powell has to message why this committee that has been noted for its consensus suddenly is breaking apart and why people believe that there is a shadow Fed, effectively, a shadow Fed chair in the likes of Chris Waller. Interesting, the Mickey Bowman comments. I'm not going to go there, but there is this question of whether Chris Waller is being taken more credibly and whether people are going to hear what he has to say more directly.
I think Diane handled that perfectly.
She was beautiful.
Absolutely
right.
Perfectly. Neil Dutter's much more fiery. He writes this: using tariffs to absolve yourself of doing anything is downright pathetic. So, Diane, naturally, I've got to ask you whether you think it's downright pathetic and whether you do think they're using tariffs to absolve themselves from doing nothing.
I think tariffs are an unknown. The rollout has been uneven. There's more of them coming on Friday. We know the effective tariff rate is lower than it actually should be right now, and that's because firms are using bonded warehouses and free trade zones to not have to pay the upfront costs of tariffs. But over time, we're starting to hit a tipping point, and that's what you're seeing in the Fed's Beige Book. That's what you're seeing in their surveys. They're seeing that the effects are starting to come in and coming off the heels of the pandemic-induced inflation, which, frankly, we have yet to fully bring down. That is important as well, because that proximity, as Jim pointed out earlier in the show, this is a different environment than it was in 2019. And that proximity to that inflation that is still with us from the pandemic, that's important.
Diane, give us the dynamic of our nominal GDP, our animal spirit. You mentioned stagflation, but if I got real GDP coming down, I don't know what inflation's going to do. Do you just assume a more dampened nominal GDP? Is that the heart of the matter, like the crater in fixed investment that Mike McKee talked about this morning?
So, yeah, what we have is the overall economy basically moving sideways in the second half of the year, not much more than that. That's slower than the first half, but not a lot slower than the first half. This is a major slowdown in the overall economy as it deals with the disruptions due to tariffs, among other things. It's been destabilizing. There's an uncertainty factor. If we get more certainty, we should get more investment as interest rates finally do come down in 2026, and you do get some of the stimulus from the One Big Beautiful Bill Act coming into the economy. Those things we know are out there, but it really is the second half of this year has a lot more headwinds than the first half did, and the first half was not insignificant given all of the hot air we've seen on tariffs.
Diane, appreciate your time. As always, Diane Swonk there, KPMG, on a breakdown of the U.S. economy and what to look for from the Federal Reserve Chair, who speaks in about 10 minutes' time. If you are just joining us, welcome to the programme. So 20 minutes ago, the Federal Reserve and Chairman Powell leaving interest rates unchanged. 2 votes to cut interest rates came from 2 Fed governors. As we've said repeatedly, the first time going all the way back to the early 1990s. Some acceptance in the statement that growth has moderated, though they still believe the labour market remains solid. On that labour market, some data still to come. This is the runway going into the Federal Reserve's next meeting. That meeting on September 17th. Payrolls, August 1, September 5th. CPI, August 12th, September 11th. In between, Jackson Hole, August 22nd. And Bob, you've said repeatedly that maybe Jackson Hole is the opportunity to have a little bit of a reset. Do you think that's still the case?
I think so. I'm still surprised that there were 2 dissents. Not totally surprised, but I would have thought with Jackson Hole a month away, you could have gotten Bowman back in the tent with everyone else and just gone with 1 dissent. That would have been okay. I think this is a very important historic Fed meeting.
Well, let's get to the nature of that dissent. Governor Waller articulated this pretty clearly in his last speech. It was quite literally called making the case to cut interest rates. And in that speech, he talked about not just the labour market, saying it's on edge, but also on inflation, that a large share of tariff increases won't be passed through to the consumer, plus any increase would fade over the next year or so. What is it about that argument this afternoon that's just unconvincing to the rest of the committee?
Well, I think Diane actually phrased it pretty well. We're all expecting some level of stagflation in the second half of the year, but we don't know the magnitude or shape of it. We don't know if it's going to be more stag than inflation or more inflation than stag. And until you see that, why go ahead and start changing monetary policy now? You've got corporate America kind of where you want them. They've paused. They look healthy. When we look at second quarter bank earnings, they actually release credit reserves into the system. There's a lot of money sloshing around the system. You look at M2, it's over $22 trillion. The reason for the Fed to start guessing 3 to 4 steps ahead to bring rates down today just doesn't make sense to me.
Aditya Bave of Bank of America agrees with you. He joins us now. Aditya, welcome to the programme. You've got no cuts for 2025. No cuts at all, and you're not alone. So just articulate the reason why and whether this afternoon's communication ultimately just reinforces your view.
Good afternoon. Thank you for having me on. So I think at the core of our view is what's going on with inflation, and there's this endless debate about the effect of tariffs, but let's not forget where underlying inflation is. This does not get talked about enough. In the last 18 quarters since 2021, how many times have we been below 2% Q over Q annualized on the core PCE? Never. in the last 18 quarters, how many times have we been below 2.5? Just 3 times, and most of that was used cars. So underlying inflation for us is stuck at 2.5%. So even if Waller's right that the tariffs really aren't that big a deal, you still have an inflation problem. And I think the Fed is not still appreciating that enough.
Although you look at, for say, housing, which is a huge component into CPI, Aditya, and prices are actually coming down in a growing number of jurisdictions around the United States. What's to say that there isn't this one-time price pop in particularly consumer goods that will fade, and you also will have disinflationary forces coming down the pike that have really been anchoring a lot of the inflation rates we've been getting?
So per our math, if housing inflation goes back to 3% year over year, which would actually be below where it was before the pandemic, that would take about 20 basis points off of the core PCE, which is why I'm saying that we're trending at 2.5 rather than 2.7%, which is where the rate was as of May. So I still think 2.5, 2.4% is roughly where you're trending, and that's a big overshoot. It's not a small overshoot. That's part of the story, and then the other part of the story is just the resilience of the labor market. Of course, if the unemployment rate goes to 4.5% or higher, they will cut rates. I think that's pretty clear, but we're just not seeing that evidence of increasing slack in the labor market.
Given that, Aditya, does it concern you that there were 2 dissents by governors for the first time going back to 1993 amid a pretty heated political environment for the Fed?
The reality is that this is a very divided committee, and I'm sure Chair Powell understands that, but that cuts both ways. Let's say he were to capitulate to the dovish dissents and cut in September without seeing signs of weakness in the labor market, there would very likely be dissents in the other direction. There were 7 FOMC members who did not want to cut rates at all this year in June, right? And I would say that the balance of data since then has been hawkish.
Bob, what's the 10-year going to do through the rest of the year? You take the summation of what we've blathered on about for the last hour. What's the 10-year yield going to do for the rest of the year?
When in doubt, 440. I think we're in a trading range.
Is that stability good for the economy? It must be.
It's really good because it's pretty much flat to the Fed funds rate where you are today.
Right.
So there's some relief in housing because of that. And I know the housing market has slowed down a lot, but imagine if you had a normally shaped yield curve once the Fed paused cutting rates and you were up over 5% on the 10-year where mortgage rates would be.
We have parts of America where it is an absolute boom economy. I mean, I was looking north of New York City this week in Bronxville. It's insane up there. Absolutely insane. So I don't, I get it. It's slow in Kansas City. I'm not sure it's slow around New York City. If you sum to the September meeting or Bank of America saying there'll be no rate cuts, what will be that tension then in the December meeting? It'll be historic.
I think what we're going to see is the effective tariff rate settle closer to 20% than 10 to 15%.
So back to 1933 or even further back?
And a few months ago, we were in that 10 to 15% effective tariff rate. Now we're in the 18 to 20%. That is going to hit corporate America. It is going to hit pricing to the consumer. There will be some pullback on spending, and corporate America will respond to that doing what they always do, reduce their flexible cost, which is labor. So I think all of that is yet to come, and that's what the Fed will be responding to over year end.
Aditya Bhaveer, Bank of America, still with us. Aditya, just before you go, just squeeze in a question on the labour market. We get payrolls on Friday. I went through the range of estimates from 170 at the high end to 0 at the low end. Aditya, what are you and the team looking for and why?
We're at 60,000 on the headline, but we're at 85,000 on private, and I think that is much more important. What happens with the headline will be a function of how much payback we get for state and local education from the pop in June, right? So set that aside, 85,000 on private. It's still a little bit below consensus, but it's an acceleration relative to June. And most importantly, the unemployment rate. Where will that land? We have that at 4.2%. That's what tells you what the balance is between supply and demand in the labor market. 4.2 or lower, I think, is just fine from the Fed's perspective. If you go to 4.3 or higher, they would get more concerned.
Aditya, we'll let you run. We'll let you get back to it. Appreciate your time, sir. Aditya Bava there of Bank of America. Fed decision behind us, news conference still in front of us. That news conference starts in about 2 minutes' time. I think we've all got a lot of questions for Chairman Powell.
Yeah, what would it take for them to have enough confidence to cut rates at a time when you have a lot of economists, including 2 Fed governors, calling for that to happen right now? What is the concern about some sort of tariff-related inflation making it that much more difficult in September, even if, in the longer term, this is a one-time price shock?
Aren't we all expecting that? Firmer goods prices through the next several months?
The key will be what is the consumer tolerance to that? If you see weakening and sort of the stag and inflation that Bob was talking about, if you see more of the stag, in addition to the inflation, that will make them feel more confident in cutting rates.
So, Bob, of those 2 reports, jobs versus CPI, if I could say to you, I'll give you them right now. You can have the 2 CPI reports or the 2 payrolls reports. What's more important?
I'd take the 2 CPI reports because that's what we're going to see first. We're going to see the impact of tariffs on pricing. Later, you'll see whether consumers accept that and then how businesses respond to that, either consistent demand or fall off in demand. But it's going to be pricing first.
Can I ask you, do you put equal emphasis on both services prices and goods prices, or do you overweight one versus the other?
No, you have to look at both, and you have to see if there's some offset. I think the goods prices are what everyone's focused on now.
In about 60 seconds' time, the chairman walks through that door. He'll stand in front of that podium and he'll make some comments for the next 60 minutes and face a ton of questions about why they didn't cut interest rates today, how he's handling the dissent. Then Mike McKee puts his hand up and Bob slipped him an email. What do you want Mike McKee to ask this afternoon?
I think you have to nail him on inflation. If they're so sure that the impact from tariffs on inflation will be transitory, and he said that in the past, why not go ahead and start bringing rates down, 25 basis points or so? Go with the 2 dissenters. 30-odd years ago, the 2 dissenters proved to be right.
Bob Michael of JP Morgan Asset Management. Bob, thank you, sir.
Happy
Appreciate
to be
it.
here.
Solid question for the chairman in a few minutes' time.
Yeah, and if CPI is the most important, you aren't going to see the consumer tolerance to it for quite a while. Well, that kind of sets up a chicken and an egg, and you don't get either of them in time.
Bob Michael should be in the press conference. The wow statistic today is JP Morgan with a modeled 18% tariff rate. That changes this entire dialogue.
There is a question as to whether we've seen the test just yet. Peter Chiv of Academy is making the argument that we haven't had the tariff test. All of that pre-tariff inventory that we've been working our way through, the fact that it's been escalating slowly, and maybe by the time we get to September, that test is a whole lot bigger. Here's the Federal Reserve Chairman, Jay Powell, stepping in front of the podium for today's meeting.
Remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022 but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we, of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right. That's what it says, and that may well. I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one, so I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, you know, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, you know, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation, sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay. The other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy, and certainly for the Fed's work and other government agencies' work, that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy is restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. And, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
We're monitoring the situation. We do, of course, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we'll have to make do with what we have, but I certainly hope that we get what we need.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level. And delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this dissent, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that, because of immigration policy, really, the flow into our labor force is just a great deal slower. And those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the 2 dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. 2 of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. But that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal, so that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the 2 were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think is continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in two directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
The chairman of the Federal Reserve, his words: "This was one of the better meetings that I can recall." Maybe you had to be there. In the equity market, we look like this. Equities shaping up as follows: down by about 0.2% on the S&P 500, on the Nasdaq positive by 0.04. The gains fading. If you check out the bond market, 2-year, 10-year, 30-year, unlocking this move right here, yields up at the front end of the curve by 6 basis points. The 2-year, 3.93. And when you push that through foreign exchange, you get some real dollar strength. Euro dollar down to 114 this afternoon, and down by 1 percentage point. Now, perhaps these market moves tell you more about positioning than it does about the Fed meeting itself. But there is one point of tension that I think is very much worth exploring, and it's on the labour market. Governor Waller is making the point that this labour market is on the edge. Chairman Powell has a different view of things. Take a listen.
If you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market.
Two headlines crossing in the last 45 minutes, I think articulating the Federal Reserve Chair's bias, a clear bias to wait. One, the totality of the data show you've got a solid labour market. And two, inflation is further from our goal than employment. That's a chairman who wants to wait.
And that's the reason maybe why on the margins you saw yields rise as he spoke, and you saw stocks roll over. A very confusing statement. I want to say I was trying to parse through exactly what he was saying. You don't see weakening in the labor market, but you do have downside risks. What are the downside risks? When do you start to see them materializing? And what is the difference between a growing downside risk and a market that clearly isn't weakening in his view?
John, I agree on the labor front. There's two Americas out there. One's Donald Trump's America, and the other's Jerome Powell's America. While he was warbling gaily, I went into the Bloomberg and looked at weeks unemployed back to 1967. Past COVID, past the great financial crisis, weeks unemployed in this country are back to a level of 2009 and that kind of pre-crisis agony. There's two Americas out there, and these two people are talking to one part here and one part there.
You mentioned the president. I think that's the second point of tension, one from within the Fed, the other outside of the Fed. There was a note from the chairman of the Federal Reserve on government borrowing costs and how the Federal Reserve doesn't take note of what it costs the government, given where interest rates are right now. That's one of the core arguments coming out of the White House to cut interest rates.
Yeah, and it's one that is falling on deaf ears, as it doesn't necessarily want to be seen as monetizing the debt, right? That would cause some sort of inflation surge. Theoretically, in economics, there is this idea, if you have a central bank that essentially is printing money by lowering rates or artificially suppressing the cost of borrowing in order to foster more spending by the government, that can lead to longer-term inflation. He's pushing back against that. Does that raise the ire of the president?
Mike McKee was in the room. Mike McKee's going to be with us in about 5 minutes' time, so stand by for that. I want to bring in the former New York Fed President, Bill Dudley, to join the conversation. Bill, welcome to the programme, sir. Is this a Federal Reserve that has the luxury of waiting?
I think they have to wait because they're not really sure what's going to happen to the economy, both on the inflation side and the labor market side. And I think they have a reason to wait because, as Powell said, the unemployment rate hasn't changed. So essentially what's happened over the last 6 months is labor demand has slowed, but labor supply is also slowed because of immigration policy. And he was very explicit about that. He really said to focus on the unemployment rate. It's basically in the same place as it was last summer. So I think, the message from this, press conference was very clear. We're not in a rush. He also mentioned multiple times that it's going to take time to figure out what the effects of the tariffs are going to be. And he also made it very clear that what he's focused on is making sure that any rise in inflation doesn't become persistent. He really wants to keep inflation expectations in check. And one of the ways you do that is by being patient.
Bill, how did you understand you don't see a weakening in the labor market, but you do have downside risks, and those downside risks are growing? Can you put that together and translate it?
Well, the way I would think about it is the payroll employment growth rate has slowed. Okay, and so if it keeps slowing, that eventually is going to be a problem. But what hasn't happened is the labor market hasn't actually loosened up because the unemployment rate is exactly where it was. So it's two things that have been happening together. Labor supply growth is coming down. Labor demand growth is coming down. I think they're worried about the downside risk because they do see this decline in labor demand. But it's not a problem right now because the unemployment rate hasn't moved at all.
Bill Dudley, Bob Michael was on with J.P. Morgan, and he floored me with an 18%, even 20% modeled tariff rate. The people that aren't that sophisticated, they're listening, they're watching, and they're going back to the 1930s with those kind of rates. Are we leading to an economy that has the kind of tensions we knew in the 1930s, where the have-nots struggle even more with an all-in 19% tariff rate?
Well, there's a big difference. 1930s, you have a depression, and then you have the tariff wars, right? This is the tariff wars, and the economy is actually doing okay. So I think you have to think of the depression as quite different because the Smoot-Hawley Act was a reaction to what was happening in the economy. I think it's actually a little bit worse in terms of the magnitude of the tariff shock compared to the 1930s because the share of imports of GDP was much lower than it is now. So this is actually a more sizable shock.
I'm fascinated, Bill, with your study of history, how our central bank should adapt to a blended 19% tariff. Is there any template for where we're heading in 26 and 27?
You're explaining exactly why the Fed's being quite patient. We don't have a template for this kind of shock. We don't know how quickly it's going to pass through into inflation. We don't know how that's going to affect inflation expectations. We don't know how the uncertainty about the trade policy is going to affect a business fixed investment. So we're in sort of uncharted territories. And when you're in uncharted territories, you want to be very cautious. And I think that's what the Fed is being at this point.
Governor Waller is making a different point, Bill, as you know. In a recent speech, he said a large share of tariff increases won't be passed through to consumers. He went on to say the increase would fade over the next year or so. What is it about his argument that you don't find that convincing?
I think he's putting too much weight on what's happened so far as opposed to what will ultimately happen. Most economists believe that most tariffs get passed through to the consumer in the end. That may not happen instantaneously, but that's what has happened historically. So I'm expecting a pass-through. And every 1% increase in tariffs as a percent of imports is worth about 0.1% on the price level. So if we're going from 2.5% tariffs of imports to 17, 18%, that's about 1.5% on the level of prices.
Right now, the market's expecting that next year you're going to see a pretty big rate cutting cycle, regardless of the economic data, almost just simply because of there being a new Fed chair who has a particular mandate. You can put aside the idea of whether or not you think that that's good or bad. Do you think that that will lead to higher inflation, given the fact that right now, even if the Fed remains on hold, we're talking about 50 basis points and then pushing it into next year?
I think we should be careful not to overstate the fact that the chairman is going to change, because there's 12 people on the Federal Open Market Committee, and those people aren't going to do what they think is inappropriate. So the chairman has to sort of bring along the rest of the committee. The second thing I would say is, the disagreement in the committee isn't quite as large as people are making it to be. Pretty much everybody expects rates are going to fall over the next couple of years. It's just a question of timing and magnitude.
You've been in the committee. You've been in the room for some of these Fed meetings. We heard that this was one of the better meetings. That was what Fed Chair Jay Powell said, and that he thought that it was a really robust discussion. Can you translate what that means?
I think what he's saying is that we're all still friends and we're all still getting on, and we respect each other's points of view. So he started downplaying the importance of what the dissents mean, and I think that's right. I don't think the dissents are a big schism in terms of the monetary policy outlook. The fact is, if you look at the summary of economic projections, every single respondent expects interest rates to be lower at the end of next year.
We've gotten through the last hour and a half here, Bill. I have to say, we haven't mentioned the dots. That's a good and beautiful thing. What do the dots do forward, given this exceptional tariff uncertainty? I don't know. John, how do you create a dot?
Got to wait until September, get a new round.
Well, that's one of the problems with the summary of economic projection. It's a modal forecast, but it doesn't really tell you that much about uncertainty around that forecast, and the uncertainty around that forecast is quite large right now.
I want to interrupt the show. John, you mentioned to me Meghnad Desai has died in London, the giant of London School of Economics. Bill Dudley, Meghnad Desai's strength was humility. What's the humility we need right now in two Americas, a boom economy, and a lot of people really struggling? What's the humility our central bank needs?
Well, I think Chairman Powell does have humility. I mean, that's precisely why he's not cutting rates today, is because he's uncertain about what the economic outlook is. So he's not prejudging what's going to happen because he doesn't want to make a mistake. So I think he's showing appropriate humility as the chair of the Federal Reserve at this point.
Bill, appreciate your time. Bill Dudley, the former New York Fed president. You mentioned Desai. Remember that word? Hubris.
Yeah.
I think that was the name of the book, right?
A fabulous book, a short, thin monograph. And what he did with general equilibrium theory, we don't need to do it now, we're too tired from the morning shows, but the answer here is humility's in order. The Alarian's unknown unknowns, that's where we are right now.
We've all been humbled coming out of the pandemic. A lot of consensus calls turned out to be very, very wrong, including the Federal Reserve's when it came to transitory. Have they been scarred by the transitory Tory? Do you think that's why they're waiting that little bit longer this time around to move again?
If you believe that they should be cutting, you could make the argument that they're not, and they're waiting to see more data because they got it wrong. And that is very much what we're hearing from people like Neil Dutta, et cetera. At the same time, the argument that inflation has remained above 2% for so many years at this point, and you haven't seen it fall. If anything, it's actually firmed up, points out why this is still such a risk for the Fed chair and why this is such a compelling argument.
Just quickly here, John, I know we got to get to Mike. I can't say enough how I disagree with, if we cut rates, it's a path to wherever. Just cut the rates once and see what happens. They can break the Greenspan.
This is your dissent?
Trend.
This is your dissent.
The TK dissent.
Yeah.
No, this is
Governor Keene.
Dissent number three.
Just have a rate cut.
My gosh.
I just, in this uncertain time, just change the rules, because half of America is flat on their back.
I'm happy to give the chairman some credit on one particular point. I think he navigated the dissent pretty well in that news conference over the last 60 minutes or so.
I love the interpretation. We're still friends. And so, we can discuss and disagree, but everyone had well-argued points of view. Look, he did navigate that well by saying this is a time of uncertainty, and uncertainty calls for robust debate, and that is what we had on this.
Will we see that at Jackson Hole? I think we will.
I think it will.
I think it's going to be maybe one of the most interesting Jackson Holes out there.
With a focus on the labor market, how much it's changing and how you measure it in a very new world, not only with the immigration, but also with AI.
And Jon Ferro on a horse, it's going to be amazing.
Do you remember you'd go around singing around Jackson Hole on a late night?
Well, Lisa's out swatting fish.
Yeah,
swatting fish? What am I, a bear?
You're out canoeing. Yeah.
Save those stories for another day. What's your canoeing impression? What was that? Yeah, nice.
Whoa, he has never done that
you
before.
did like the water impression. Nice. I like that too. This comes from Wells Fargo just moments ago. Optionality maintained. I think that's the conclusion of a lot of people. Optionality maintained going into the September meeting. Mike McKee was just in the room. He joins us right now for more. Mike, welcome back to the show, sir. What was your big takeaway from the news conference?
Optionality maintained. I mean, that was basically Jay Powell's goal. He maybe has disappointed the markets, those who were leaning into a September cut, just because we had the 2 dissents for July and because it's going to provide more data between now and then. But Powell tried to make it clear that the data could go either way. And that's, I think, something that maybe people in the markets had sort of forgotten. The biggest issue for the Fed is that the Trump tariffs have not taken effect yet in large measure. We just got copper tariffs during this news conference. More are coming. So it's going to be very hard for the Fed to know by September necessarily whether we're going to have a large inflation increase or not. Powell seems to think not, and he's still in the camp of those who are looking at it as a one-time move. But he does seem to accept a little bit of the Waller and Bowman argument that we could see inflation rise more if they lose control of inflation expectations. And certainly the anecdotal stories we get are that companies are raising prices and consumers are noticing it and they're not happy about it.
Maybe this was a meeting in operation, optionality maintained, and it was a successful one. It really threw the emphasis on Friday's data on the jobs report, not just necessarily the headline number, but the unemployment rate. Suddenly that becomes the most important number of the week, potentially. Mike, how much did you see a spotlight thrown on exactly that composition?
Well, it's the unemployment rate the Fed has been looking at for some time, because if companies are letting people go, then you have a problem because you lose their salaries, their wages, and people stop spending. And then people get afraid that they might lose their jobs, too, and pull back. But the thing that the Fed is looking at is not so much the unemployment rate level, it's how fast it moves. A number of them have said that if we got to 4.5% fairly quickly, which in theory could happen by September or maybe the October meeting, then they would be really concerned, because that would suggest that a lot of companies are moving at the same time. If it inches up to 4.2% on Friday as forecast, not going to be a big concern. We'll look at the size of the labor market, of the workforce, and if it inches up to 4.3% and then by September, they're not going to be overly concerned. So watch the rate of change much more than the change itself.
Mike, great work as always. Thanks for dropping by again. Michael McKee there of Bloomberg with the latest. Just got this note from a Bloomberg subscriber. I'll read it to you. We want to remain open to different points of views here. The Fed likely has it wrong. High rates are feeding inflation expectations. High rates are feeding inflation expectations. People look at the cost of housing, rents and mortgages. If rates come down, so will inflation expectations, because it will unlock housing. And the housing market is most important.
Well, this seems to be in tandem with what President Trump is arguing, that if people feel like they could borrow more cheaply, could unlock the housing market. I'm not sure I'm totally following that aspect of it. I do think, though, there is this belief that because of where bond yields are, people, in particular savers, which make up an increasing proportion of the population, are getting a lot of income, and that income can go directly back into the economy. So there could be an argument there. Unique arguments.
There's hope potentially that maybe it would unlock some supply for certain people around this table sitting on mortgages and paying 2-3% interest rates, and that certain person might be choking as we speak and talk about the housing market.
Put something in my water. I couldn't quite keep it together.
I want to talk about this equity market. Equities declining by 0.4% on the S&P. Following the news conference, bond yields started to shift higher. You pushed that through foreign exchange and you started to get some dollar strength. On the market, Jeff Rosenberg of BlackRock joins us now for more. Jeff, welcome to the show, sir. I just wonder from your perspective whether these moves tell you more about positioning than it does anything that was said in the news conference.
Yeah, Jonathan, you say it often, the first move is not necessarily the last move on the data. I mean, I think they're pretty consistent with the headline you talked about just a minute ago in terms of optionality preserved. I think when you look at what Powell came back to many, many times was this balance of risk focus and how unique the challenges are, that you have an inflation challenge and you have a labor markets challenge. And the focus, and we'll be back on Friday to talk about it, the focus on the unemployment rate. Remember, he also said that there's a risk inside of that the balance that you're getting is because you're getting the offset on the supply side, but that the demand side decline was indicative of downside risk. And that to me was a little bit of a tell of, if you see that scenario where the labor market balance of risk starts to move more in favor of cutting, that they'll be responsive to that. Otherwise, it is this overshoot in terms of inflation. He said it many times. They're at target on the unemployment rate perspective, so the labor market's at target, and you're off target in terms of inflation, and that's what justifies the slightly modestly restrictive. But if the inflation piece moves in their favor, meaning it is transitory, the tariff impact moves through, they'll move to cut rates off of restrictiveness.
Well, Jeff, pause. How long are they going to have to wait before they can make that call? Because what you just said doesn't sound like September.
Yeah, that is the interesting part when we talk about this, inflation pass-through and transitory. We're just starting to see, and the chairman, addressed this in the press conference, that we're just starting to see some of the incidents in terms of tariff impacts. Now, that's not broad-based inflation, that's in goods inflation, and so they're going to care about the impact and the balance between services and goods, and he talked about a little bit of that trade-off. But to your question, it is going to be a tricky environment. If the unemployment rate stays stable here and the labor markets don't decelerate, which is Waller's concern, and inflation starts to accelerate, it's going to be hard for them to be cutting rates into that environment. Remember what he said was, we believe we're modestly restrictive, but we don't know where we're at, and the data tells us. And the data is consistent with less than modestly restrictive because the economy is doing well enough despite the setting of a policy rate otherwise being somewhat above their idea of where neutral is.
Jeff, it seems like the Fed is talking about how they engage with monetary policy in a very traditional way. It seems like the market is exploring ideas of whether the rate-setting policy has served a different purpose recently. And Jon was having me explain something that someone sent him, and I lost my breath because I was trying so hard. But there is this idea that actually keeping rates high is inflationary in and of itself, and that because the growth and the inflation trajectory seem to be roughly in balance, it is appropriate and actually the right course of action to lower rates. That's what the president has been arguing. Do you see anything to suggest that monetary policy is just at a profoundly different place in this cycle and serves just a completely different function in the economy?
Well, I think we have to remember that a lot of the pass-through of monetary policy flows through financial conditions. Interestingly, it was hardly mentioned. I think Powell mentioned it very briefly about financial conditions remain accommodative, but that a lot of the impact of monetary policy is not the direct impact into the economy in terms of credit rates. A lot more of that is on credit spreads. That's financial conditions. And credit spreads are exceptionally tight. They're more indicative of mid-expansion level than any kind of slowdown concern. And that the pass-through to the housing market, which was, I think, the question you choked on a bit, is much more about what Powell said. It's more about term premium and things that the Fed doesn't directly control. So I think the bigger issue in terms of monetary policy is the financial conditions impact. And financial conditions are both about monetary policy, what they directly say, but other aspects. A lot of the financial condition easing that we've seen is more about the other fiscal policy, the passage of the bill, the passage, the extension, the elimination of the risk of a big increase in taxes. And the tariff uncertainty is also a big part of the financial conditions easing. So it's not just about monetary policy directly in terms of its contribution, but the overall picture and financial conditions. That creates the either easing feature that we're having right now or a tightening feature when financial conditions tighten.
So to put that into a market call, does the fact that the Fed is remaining on hold give you more confidence to invest in long-term treasuries with the belief that this Fed is going to try to get inflation under control?
I think that the longer-term Treasury impact has more factors associated relative to near-term Fed policy. I think the short-term Fed policy and the inflation piece is additive to the long-term perspective, but it's challenged by a couple of other things. One is you're coming into this environment after a long period of a collapse in term premium. You're having a change with respect to inflation and inflation uncertainty that is a reflection of the post-COVID environment, where the pricing of an inflation term premium is resetting higher. And you have a change in the global environment in terms of the level of trade, the amount of recycling, the holding of reserves, and finally, the attractiveness of long-term treasuries as a portfolio hedge. We've had a significant structural change in stock-bond correlation. It's a reflection of all those factors, in particular, the movement from an environment of too little inflation. We're going on 6 years of too much inflation relative to target, and that challenges the effectiveness of long duration as a portfolio hedge, which reduces its attractiveness. That encourages an increase in term premium and changes, how much we want to hold long-term treasuries in a portfolio as a result of all those structural changes.
Jeff, we got two Americas. We got an America flat on its back. I think Powell talked about that today. The president talks about it each and every day. Look at the housing market. Just as one example, your Carnegie Mellon is going to take in billions and billions of dollars into Western Pennsylvania to do AI. How does a central bank prosecute monetary policy given the polarization of America?
Yeah, Tom, it's a frequent theme we've talked about on the shows we're together in. It's something we look at a lot. The distribution of economic outcomes matters as much as the central tendency. Unfortunately, what we heard a lot from Powell today, and it's the kind of simplification of economic statistics, is it looks at that central tendency and not the distribution.
Yeah.
But the distribution matters. The question was raised about delinquency rates at the high end, which was a bit surprising. He said, I don't know what to make of that. I read that too. I think we all did. And so those distributions matter. And I think the problem for the Fed is setting the interest rate policy in the middle isn't necessarily going to solve the problems at the bottom. Powell talks a little bit about this in terms of what monetary policy is equipped to deal with and what other policies like fiscal policy are going to be better attuned to address some of the inconsistencies or inequities across the distribution. And that's something that Fed policy is just not designed to address.
Bottle it. John, that's the clearest explanation of distributional policy I've heard so far. There's two Americas. Maybe it's like England, maybe it's like France. I don't know. But we're living it, and Powell's living it in real time.
Hey, Jeff, let's sit on the market for a couple of beats. You mentioned correlations, messy correlations back in April. We had risk breakdown alongside the risk-free asset. The dollar didn't strengthen off the back of it, even though we had higher bond yields. How much comfort can you take in some of the developments we've seen cross-asset over the last few weeks, the last month or so?
Yeah, I would say the last few weeks or so, you've seen a little bit of a return to normality, stock-bond correlations kind of coming back in line. It was during that period that you just referenced that was, the Liberation Day tariff uncertainty around April. We saw some dramatic breakdowns in historic correlations of what you expect from traditional hedging assets, whether it be the dollar or gold or fixed income. And I think that lesson of that shock period has to be learned, that a lot of these breakdowns are due to some structural changes, the biggest one of which I talked about a minute ago, and it affects fixed income dramatically, and that is this shift in environment from too little inflation to too much inflation. Where did we hear it today? We heard it today when Powell talked about the balance of risk, and that today, unlike in any prior period, the Fed is challenged on both sides of its dual mandate. There's an inflation challenge and a growth or maximum employment challenge. And that tells you that the Fed is more constrained. You can see the constraint. It's in the debate. You've got two dissenters differing in viewpoints of which side of the dual mandate should we focus on. But what that means for the stock-bond correlation and the bond hedge is that the Fed can't be as aggressively accommodative as they were in an environment where there was not this challenge on the inflation. When you had too little inflation, you could cut interest rates. It was called the divine coincidence of monetary policy. You could achieve both goals, raise inflation and support growth at the same time by cutting rates. That was the era of massive hedging efficacy of fixed income. We're out of that era. Where is the hedging efficacy? It's going to be more in the short end. That's going to challenge investors. We've got to think about alternative forms of diversification, think differently about portfolio construction. But that's a structural change. And we saw it a little bit in April, kind of more recently, kind of coming back. I went over, learn the more recent data, and it's more about recognizing the structural change that I think is going to be persistent.
To be more specific and build on what Jon was talking about, one correlation that broke down was the idea of higher rates in the U.S., meaning that there would be a stronger dollar. It seems like as we do see rates go up on the heels of this press conference, we are seeing that ongoing dollar strength. And as Jon nodded to, this partly could be a positioning thing, how underweight people had gotten the dollar versus the euro. But do you think that this is a marking point in terms of the solid straight line downward, weaker in the dollar that we saw in the first half of the year is over?
I think there is a shift, and you can look into the equity markets and into the cross section of equity markets to really see how dramatic that shift is. Certainly, you see it in terms of the index performance and the recovery and new highs, but you see it underneath that, the performance of cyclicals versus defensives. Fully recovering. But you also see it in the kind of recovery in animal spirits, the reach for risk that we see in, say, the outperformance of unprofitable companies, in the performance that we see in quality versus high quality versus low quality companies. And so I think the shift in the macro narrative around tariffs is really reinforced around, we've removed the tariff uncertainty. We're no longer trading off of tariff headlines. Yes, we have the tariff implications still in front of us, but the kind of bigger tail risk has been removed, and associated with that, to get to your question, you kind of return to a bit more of U.S. exceptionalism. Alongside the AI trade has come back. It's recovered from the DeepSeek kind of drawdown back in February. So a lot of these under the surface themes have come back. And one of those that is associated with it is this kind of U.S. exceptionalism. And that's been pretty favorable for the dollar. Away from kind of the macro story around the Fed, it's really some of these underlying macro themes, secular themes around AI, U.S. exceptionalism.
Hey, Jeff, well framed, as always. We'll see you Friday for payrolls. Appreciate your time, sir.
Will.
Thank you. Thank you very much. Jeff Rosenberg there of BlackRock. I think Jeff articulated things pretty well just there. He sits at a flow monster. And a lot of those flows have come back home to the United States. That's where a lot of the money's been going over the past few months.
And it's not because of parsing exactly who's going to dissent on the Fed and exactly what metrics they're looking at. It's because of what we're going to get in about 16 minutes' time with Amazon, Meta and Microsoft today, and Amazon and Apple tomorrow. That has been the driver, and that's what we see on an ongoing basis.
$11 trillion worth of names. 4 names. 1/5 of the market cap of the S&P 500. Big tech is a major piece of the puzzle.
I'm still getting over Google's numbers. I thought they were absolutely extraordinary, and just see what, we'll see what we see here. Jon, if we stay on another hour, I think we should. We'll get DXY to 100. That'd be a good idea.
You want to stay for another 60 minutes?
I think we should stay for another 60 minutes.
Just explain to the audience why you'd like DXY a little higher and euro dollar a little lower. Where is it you'd like to go?
Well, we're sitting at Sweeney's going to Rome. I think that works out.
Let's just say 114 is better than pushing 120, right?
But Lisa, help me here, because the lad from England is on holiday. You and I go on vacation, which is 72 hours if we're lucky. August in Capri, is that where we're going?
I gave up my 30 days in August. I did. I'm fully American. I've been here 10 years.
Okay. And I'm going European.
I fully embrace the culture, no vacations. I'm off next week. I'm off next
exactly.
Week.
But
I'll summarize it. I don't have a life, so I'll watch DXY go to 100.
The dollar is a whole lot stronger. Equities pulling back just a touch, but this is a Federal Reserve that still has a bias to cut interest rates. This is a chairman, though, with a bias to wait, and that's a key difference.
The idea that there hasn't been a weakening in the labor market is really notable and puts him in stark contrast to Chris Waller.
Coming up tomorrow, stick with Bloomberg Surveillance. We'll catch up with Chris Ferro of Strategas, Mira Pandit of JP Morgan Asset Management, the former Kansas City Fed President Esther George, and Gargi Chowdhury of BlackRock. From New York City for our audience worldwide, thank you for choosing Bloomberg TV. This was a Bloomberg Surveillance special.